everyone. Thank you for tuning in to this episode of Whitley Penn Talks. Just so you know, this was a pre recorded webinar, so the slides to follow along with the webinar are housed on our website, www.whitleypenn.com. Make sure you check it out to follow along. Thanks.
All right, good afternoon, everybody. First, let me say thank you from Whitley Penn. Thank you for trusting us with your time and allowing us to help. I know there are a lot of heavy hearts on the line today, and I'm sorry that it's under these circumstances that we're talking about and discussing disaster relief. At the firm, we've been adapting, coming together as a team more than ever, and I know we are going to be a better firm because of this when it's all said and done. There's lots of benefits and things that are forcing us to change, and I know that we're going to be better. So very quickly, let me introduce myself, the firm, and our speakers, and we'll get started. My name is Toby Cotton. I'm the partner in charge of the tax department at Whitley Penn. Later this year, I'm going to celebrate my 19th anniversary with the firm, so I'm proud of that. I can't tell you how proud I am to be a part of this team and how we've responded during this crisis. You know, the firm's grown a lot, grown quite a bit since I started with the firm almost 19 years ago. The firm was founded in 1983 in Fort Worth, Texas. Currently, we have over 500 team members with offices in Fort Worth, Dallas, Plano, Houston, Texas City, and Austin. You know, we're very, very proud to be a Texas-based firm with a global reach. I know that there's a lot of friends and family and a lot of clients on this call today, and a lot of people that didn't know about Whitley Penn, so we're excited to have everybody on this call. And y'all are all in for a treat today. We have Kristen Syed and John Karp who are going to walk us through the CARES Act. Kristen's a senior manager for us in our Houston office, and she's been with us since she was an intern, so we're very proud. She's homegrown. She's one of our rock stars. You know, John is one of our lead technical partners in the firm. He's in our Dallas office. We're very proud of John, his accomplishments. He's been affected by this virus personally, and he's going to tell you that story as well. But John sits on the Texas Business Hall of Fame board and is currently serving as the chairman. So I'm going to let them take this away, but I encourage every one of you, reach out to your neighbor, stranger, whoever you see in need during this time. Encourage you to keep your spirits up. I know there's some encouraging news coming from Kristen and John, and at Whitley Penn, we're proud to help. And you know, we're trying to spread the word as best we can about the CARES Act and the benefits of that to business owners and just people in general. So we're just excited to help any way we can and know that we're there for you. So John and Kristen, take it away.
Well, good morning. So my name is John Karp, and as Toby said, I'm a partner in our tax department. And Kristen, why don't you quickly introduce yourself?
Hi, everyone. Glad y'all are on the call with us.
So this way you kind of know the two voices that'll be coming at you. So, you know, I do think that whether you have had yet, besides the fact that we're all just sitting at home now, staring at four walls and trying to figure out how we can go outside if you're able to go outside. But I think every one of us will be touched by this coronavirus act, or this coronavirus, not the act, but the coronavirus eventually. So, and we are all going to have our personal stories. For myself and my family, and even tangentially the firm who was extremely helpful to me in this process. My daughter arrived back from Ireland with a trip, and 12 out of 29 folks from that trip, which was a school-sponsored trip, ended up testing positive. Of those 12, 3 had acute symptoms, and so my daughter spent 7 days in the ICU in Florida. And so while we still don't have my daughter back to Dallas, where I reside, and we were hoping that maybe by next week we'll be able to get her back. We just don't know. The way this works is once the boards of health test you, they really want you to have 2 negative tests. And by the way, I think as a population, just so everybody pays attention, we should all want 2 negative tests to make sure that someone's not out too early walking around giving this virus to everybody. The reality is, like I said, it's going to affect everybody, and everybody's going to be able to is going to have some relation or going to know somebody who has had and contracted this virus through a series of contacts. So with that, besides the virus that has really affected my family, then trying to, what I feel like is drinking through a fire hose, coming through and coming to determine how to interpret this act because I've been drinking through a fire hose, both on a personal level with my family dynamics. Oh, and before I move on, sorry, I told you how she was in the ICU for 7 days. She is on the other side of this, because I'm sure that might have been a question. So she is feeling great. She'll tell you she's perfectly healthy and ready to run around, just can't leave her four walls in Florida. So now onto the disclaimer. As I said, we're drinking through a fire hose, and that fire hose realized we could hang up this conference, right? Everybody can take off and legislation could come out or some guidance come out, and it's coming out hour by hour. So here's a disclaimer to make sure that if you're not our client, and that you're reaching out to your professionals, if you are our client, that you're reaching out to us, because it is hour by hour, and just to make sure you're doing that. So, and just don't take this advice as we go on. The agenda today is, we've just divided this into two areas. One is money in your pocket, Paycheck Protection Program loan, economic, which we're going to talk about, and that's the new thing everybody's looking at right now that opens up tomorrow. The economic injury disaster loan and emergency economic injury grants, the employee retention credit, the recovery rebate credit, and then we'll go into a few of the tax law updates. And we'll start with the Paycheck Protection Program loan, which is commonly referred to as the PPPs, the just PPP loan. And realize what legislation did and what Congress did is they gave us $350 billion in loans available to businesses with fewer than 500 employees. And so that, by the way, that dovetails on your definition of an employee. So to make sure that everybody understands, if you're a partnership and there's just 3 partners, you're not employees, but there's other codes out there for you as self-employed folks. So it's businesses with fewer than 500 employees, sole proprietors, nonprofits. And if you're in a nonprofit situation, this is what's out there for you, right? And that applies to churches, et cetera. It's not just a 501c3, it's nonprofits. And you must have been in operation on February 15th, 2020. So the covered period runs from February 15th, 2020 through June 30th, 2020. So the 100%, and then this loan is guaranteed, it's 100% guaranteed by the federal government through December 31st, 2020, which means that you have no personal guarantee required here. So the years in interest, so there's conflicting data. And so per the law, which is the actual, there's 883 pages of legislation. And it's really good nighttime reading if you can't fall asleep. But it's a maximum maturity of 10 years and an interest rate not to exceed 4%. Per the Treasury Department, 2-year loans and interest rates of 0.5%. So again, you can see how that differs. 0 loan fees, so there's no fees associated with that. Payments for any loan amount not forgiven will be deferred for a total of 6 months to 1 year after disbursement. And that's going to be up to the administrator. So recognize, for whatever's not forgiven, then you're just going to have to pay back it in way, depending on which way the treasurer, who's going to, which interest rate, right? The question is it going to be 0.5 or 4%? And that's going to be between you and your bank. Independent contractors are not eligible, but they will have some other options as well in here that we'll talk about. Payments. So there's some other rules that I want to just make sure everybody understands, that while here's the legislation and the Paycheck Protection Loan, there's a whole other set of rules out there that the SBA deals with. All the Paycheck Protection Loan does is it's an overlay to all the other existing rules that are already out there, unless they pull some of those back. So there's a lot of questions, and we've received a lot of questions about the affiliation rules. So recognize that when you get to the affiliation rules, those are the old rules. And so then there's some exceptions if you're a restaurant, depending on your hotel, and some franchise rules. So, and this particularly comes up in the PE groups. And so, that's going to be everybody's individual situation when you get to your employees in terms of your control. So when do you apply for this? So it's starting April 3rd, tomorrow. And then it's small businesses and sole proprietorships can apply for and receive loans to cover their payroll and other certain expenses through their existing SBA lenders. So really, everybody should have hopefully, if you haven't already, when we hang up, be reaching out to your SBA lender. Then starting April 10th, 2020, is independent contractors and self-employed individuals can apply and receive the loans to cover their payroll and other certain expenses. Let me be clear that I'm not real sure. Have all been talking about what's the difference between a self-employed individual. We know what a self-employed individual is and a sole proprietor is, but if you're a self-employed individual that has a payroll, have W-2s and payroll that you pay other folks, well, then we think you should be applying on April 3rd. If you're in a partnership model where you're getting a guaranteed payment, we think that's an April 10th. But there's not a lot of, they haven't really defined this for us. And so to keep in mind that it's up to your banker really when to submit your application. So if they'll take your application tomorrow, then take it. I think the other message is there's $350 billion. You want to be one of the first people to try and tap into that $350 billion because we don't think it's going to last. All right, so how is the loan size determined? If you do not have seasonal employees, use the 1-year period before the date on which the loan is made. So the maximum loan is 2.5 times your average monthly payroll cost during that time period. So understand that most companies, some don't even have all that data readily available. And so some of the feedback we've been getting from the banks say that they'll just take your 2019 numbers and let you run with that. If you have seasonal employees, use the 12-week period beginning February 19th, 2019 and ending June 30th, 2019. You can opt to use March 1st, 2019 as your time period start date too. If you were not in business between February 15th and June 30th of 2019, it's 2.5 times your average monthly cost between January 1st, 2020 and February 29th, 2020. So then what's a payroll cost? Right? So payroll costs, compensation, salary, wages, commissions, or other similar compensation, payment of cash or equivalent, it's capped at $100,000. What does that mean? If I make $110,000, I don't get to include 10, but I can still count my 100, all right, for my staff person. For a sole proprietor or independent contractor wages, commissions, income, or net earnings from self-employment, again, capped at that $100,000 on an annualized basis for each employee too. Then there's payment for vacation, parental, family, medical, or sick leave. The way we're also reading the law is that really you can, if you make, let's say someone makes $5,000 a week. I realize the math isn't going to add up here, but is that what, or $5,000, $10,000 a month, so $120,000. But you give them a month of vacation. Well, we think that month of vacation, that $10,000 for the month of vacation, you get to subtract that so that you actually could have more. So the vacation, you can take your vacation pay out of your salary, which means that you're going to have your salary less the vacation is the compensation you're going to put into these numbers. And then you get an allowance for dismissals or separations. You get payment for group healthcare benefits, including premiums, payment for any retirement benefits, state and local taxes that get assessed on compensation of employees. What are payroll costs what can't you include? It's payroll taxes. So, and again, different banks are doing different things. If you read the law, it talks about, not that I want you to remember this, but Chapter 24 of the Revenue Code, and what that deals with is your withholding taxes. And so it says, so the law states that taxes in this chapter are not includable as payroll costs, right? But you and I would all consider them as gross comp. So some banks have said, hey, there's gross comp, just give me your gross wages. And other banks have said, don't do that. We have some banks that have said, hey, just give me everything you have, your 1099s, your W-2s, your 941s, your 940s. Whereas we read it that we don't think the independent contractors are in that mix as well. So, and then it's any compensation that's not in, you can't include compensation of an employee whose principal place of residence is outside the U.S., and then qualified sick leave or family medical leave for which a credit is allowed under the new Relief Act. So if you're getting a credit someplace else, they're not going to let you double dip.
Yeah. So let's take a look at a pretty straightforward example. XYZ company applies for a paycheck protection loan. They had $600,000 in payroll costs for the prior year for a monthly average of $50,000. They are entitled to a fully guaranteed federal loan, assuming it's made before December 31st, 2020, equal to the lesser of $125,000, which is their average payroll cost of 50 grand times 2.5, or 10 million. The entire thing is always going to be capped at $10 million. Now, how can you use this money? You can use it for any of the payroll costs that we've noted before, continuation of group healthcare benefits, employee salaries, commissions, or similar compensations, payments of interest on any mortgage obligation, rent, utilities, and interest on any other debt obligation that were incurred before the period. So we've already received the question quite often on, do you get to choose where you put your money? And the answer is yes, but I'm going to talk about in a few slides a reason why you may want to be aware of where you're spending that money. But on the baseline, you get the loan, you spend it in one of these categories in whatever proportion or allocation you want to do it with. Now, the most attractive thing about this PPP loan is the free money that you may be hearing out there. Be aware of yourself. Any amount of this loan used within the first 8 weeks of receiving the loan on payroll costs, as we've defined, on mortgage interest, on rent for a lease that was enforced before February 15th, and certain utility payments is going to be 100% forgiven tax-free. You're not going to have to pay it back. It's not going to be income. It's tax-free to you. You're going to submit paperwork to the lender on an application to determine and provide support for those expenses, but it's completely going to be tax-free if used for these 4 categories. So continuing with our example from before, in the first 8 weeks after receiving the $125,000, the business pays for $100,000 in payroll costs, mortgage interest, and utility payments. They're going to be eligible to have the entire loan forgiven, to have the $100,000 forgiven. This does not create a taxable income. The $25,000 that's remaining is going to not be due for 6 months due to that deferment that John talked about. Now, the reason why you want to be aware of how you're using your money is because of this forgiveness period. John, you want to talk about that?
So keep going.
Yeah, the forgiveness. If you don't spend the money in if you spend the money in the 8 weeks on salary, and then also reduce your workforce or reduce the salaries and wages paid to the employees during those 8 weeks, part of the loan is not going to be forgiven. So while earlier we said that any of the loan can be used on any of those categories, if you decide to pay your mortgage interest and therefore reduce salaries paid to employees, part of your loan forgiveness could have an issue there.
Right. And then the addition though is the rule is on the 100,000, right? So if you all of a sudden said, okay, I've got an employee that makes 175,000 and I need to reduce their compensation to 150, that doesn't count in here. So it's only for the folks that make less than 100,000 as far as the reduction. So that's important to remember, that you may have to make some calculated decisions based during that 8-week period, making sure that you that you don't penalize yourself to have the recapture of compensation.
Yeah,
and
then you can avoid this if you rehire or increase your employees' pay again by June 30th, 2020.
Right. Okay, the economic injury disaster loan and emergency economic injury grants. And this is a different type of loan. So what is it? It's lower interest rate, loans up to $2 million with a potential deferment on how you pay. But here's the difference. On the EIDL loan, this is not a forgivable loan. So whereas the PPP loan is forgiven, the EIDL loan is not a forgiven loan. So who is eligible for this? Small businesses, including sole proprietors, independent contractors, cooperatives, employee-owned business, private nonprofits, tribal small businesses. The important component here, and this question has come up too, is, well, what can I have an EIDL loan and a PPP loan? The answer is yes, but you can't use them for the same thing. And what a lot of folks have talked about doing is they're going and they're running at the EIDL loan, thinking the PPP loan may come and pay off the EIDL loan in the end. But again, they haven't said that it has to. And then Kristen, I know you have a story that you want to tell?
Yeah, so the interesting thing about the EIDL loan is that you don't have to have wages to get this. We're seeing, as John mentioned when he was talking about the PPP loan, different bankers are having different interpretations on whether or not 1099s and independent contractors can be included in the calculation of how much you can get for the PPP loan. I know my dad personally only has 1099 contractors. He tried for the PPP loan and his bank said you don't qualify to get this. That's not been the case at other banks, so to be determined. But for him and for somebody else who doesn't have any W-2 employees, this EIDL loan is going to be for you. You don't have to have wages and you can go and apply right now. The other benefit to the EIDL loan is that though there's not a forgivable amount like the PPP loan, there is a $10,000 grant out there. And if you've been in business since January 31st of 2020, you qualify for this grant. And you apply for it. When you apply for the EIDL loan, you're going to get the $10,000 within 3 days of applying for the EIDL loan, and you do not have to pay back the $10,000 under any circumstance. You can also use this $10,000, unlike the PPP forgiveness portion that's specific on how you have to use the funds in the first 8 weeks. This can be used on any sort of business costs. So production costs, business obligations, anything that you have for business, you're going to be able to use this grant for. So again, for somebody who doesn't have employees or is being told by the banker you don't qualify for the PPP, go and apply for this EIDL loan. Try to get the disaster grant that's going to be $10,000 in your bank account, and this should be able to help you out. Additionally, for this loan, any loan made under this program by December 31st, 2020, and less than $200,000 is not going to require a personal guarantee. So you won't have to worry about personally backing it if the amount's less than $200,000. Also, we have up on the slides right now the website you can go to apply for this loan right now. So we encourage all of our clients who are interested in that portion of it to do so. So the next portion we want to talk about, separate from the EIDL loan and the PPP, is the employee retention credit. This is an area that's going to make bookkeepers and anybody who files their own 941s and payroll tax returns head spin a little bit, because this is a credit you're going to get in 2020 only to go against the employer's portion of Social Security tax you would normally pay. And there's a few definitions we need to get through, so bear with me as we qualify everything. So if you have a business that is more than 100 employees, in order to take this credit, two things are going to have to be considered. One, your operations are going to have been shut down by a governmental authority. So maybe a bar would be a good example right now, that you've been shut down because Harris County or whatever county you're in has told you cannot operate, and you have more than 100 employees, you could qualify for this. Additionally, the credit that you're going to receive to offset your Social Security tax is 50% of the wages of the employees who were furloughed. So you can only use the employees who were actually furloughed in this situation if your business has more than 100 employees. If your business has less than 100 employees, you would qualify to use this credit if, like point one, you had to be shut down due to governmental authority, or if you do a calculation and if during any quarter in 2020, your gross receipts for that quarter were 50% less than what they were for the same quarter in 2019. Okay, so you'll have to compare gross receipts, not net income, but gross receipts quarter to quarter, 2020 to 2019. Additionally, different than the companies with more than 100 employees, if you have less than 100 employees, the credit is based on all employee wages. Your employees do not have to be furloughed, including health benefits. Now, one caveat to both of these calculations of employees' wages is that no employee can count towards the calculation of more than $10,000. So you can see about the third bullet point up there, qualified wages from each employee is capped at $10,000. So you may get a lot of this credit in the second quarter of 2020 when you applied against your Social Security tax. And if all of your employees have made more than $10,000, you don't get a credit the rest of the year. You will have met that cap of $10,000 per employee in the first quarter. So Other details about this, the credit is going to be refundable if it exceeds your business tax liability for payroll taxes. Now, that's the Social Security section that it's going to go against, but it is going to be refundable. If you use a PEO, the retention credit belongs to you, not the PEO. So you need to be on the phone with your PEO provider to make sure that they take this into account and what they're withholding from you and remitting on your behalf. And you're not going to be able to double dip. So wages must be reduced in this calculation by the amount included for other credits, work opportunity credit, the employer credit for paid family medical leave. And if you take out a paycheck protection loan, the PPP, no credit is going to be available. So recognize that will be a trade-off if you get the loan versus not being able to take this credit.
So by the way, on that retention credit, realize that since some of you you're looking at your filing of your forms and how you take that credit, you hopefully will know because of timing whether or not you get the PP loan. So the delayment of the payment of employer taxes, really this is just a loan. So on the employer's share of the 6.2 Social Security tax that would otherwise be due from the date of enactment through December 31st, 2020 can be paid on December 31st, 2021, which is 50%, and then the other 50% on December 31st, 2022. Self-employed taxpayers can also defer that 50% of the self-employment tax, but again, it's the 6.2% of Social Security through the end of 2020. And then again, you can pay it 50-50 in 2021 and 2022. If you're an employer, you can also take your PEO, and it's the same directive as the retention credit, and you can defer the applicable payments. I think the important part is to remember this is the ultimate employer's benefit, not the PEO's benefit. But again, this is not available to any business that takes out a paycheck protection loan. They are not going to let us double dip here. So that's very important. So there's a lot of different acts, and I've already had a phone call about the delay of the payment of the payroll and self-employment tax. And remember, this is going to be a second quarter filing issue, but yet people have to make the decision today, do I pay my taxes? And in good conscience, as a practitioner, I can't look at any one of my clients and say, oh yeah, don't pay your taxes, because what I don't know is if you get that PPP loan, which then you can't use this, are you going to be subject to late payment penalties? And the problem is they haven't told us that. And so remember, that's a 10% late payment penalty when you're looking at payroll taxes. Now, again, it'd only be the employer side, so it wouldn't be as bad, but it could still be pretty bad depending on the size of your payroll. And when you think about what your deposits need to be.
Yeah. Okay, so let's talk about something. We're probably all getting pretty familiar with this now. The individual recovery rebate credit. This is all the checks the government is talking about sending out to people right now. So let's talk about how that's going to work. Right now, the IRS and we don't have a timeline on when they're pulling this information. So for all we know, they could have done it at noon today. We don't know when they're going to pull this information, but when they do, the IRS is going to look at your 2019 tax return. If you haven't filed your individual return, they're going to look at your 2018 return. And if you haven't filed your 18 or your 19 return because you're not required to do so due to something like you only receive Social Security, they're going to look at your Social Security benefit statement. Once they look at your return, they're going to cut you a check. Single people are getting $1,200, and married filing joint are going to get a check for $2,400. That amount's going to be increased by every child that you have under the age of 17 by $500 per child. There's nothing on your tax return that matters to figure out if you get this other than your adjusted gross income. It doesn't matter if you owed tax, if you owe the IRS money now, or if you didn't have a certain amount of minimal earned income. None of that matters. It's just based on your adjusted gross income, your AGI, and that's an actual line item on your tax return. So you can go and look at it to see if you would qualify. To get the check, you're going to have a valid Social Security number for yourself, your spouse, and any qualifying children. And if you're claimed as a dependent on someone else's return, you're not going to receive a check. So this may be the time to evaluate if you have a child, maybe 17-year-old, who does some lifeguarding and wants to file their own return, if you want them to do that for 19 so that they can get this check. This payout is going to be limited based on your adjusted gross income. It starts to phase out when, as a single person, your AGI exceeds 75,000, or if married filing joint, your AGI is more than 150,000. And we put once you're over the thresholds, you lose $5 of your payment for every $100 your AGI exceeds those thresholds. And we added just some standard examples up there. Single with no kids will not get a check if your AGI exceeds 99,000. Married with no kids will not get a check if AGI is more than 198,000, and married with 2 kids is completely phased out if your AGI is more than 218,000. One thing to keep in mind, because I know that this makes a lot of people feel pressured to run out there and file their 19 return if their 18 return had a lot of income and they think they could get it for 19. This payment is an advance credit of what we're going to again compute on your 2020 tax return. So they're kind of prepaying based on what's on your 19 or 18 return because that's the only information they have on file. But we're going to do the calculation again when you file your 2020 return. If for some reason you did not receive a check today because you had a higher income that phased you out, but you would receive it based on your 2020 activity, you're going to get a credit on your 2020 return for the difference or for the full amount. So you're going to be made whole. I recognize time value of money, but you're going to be made whole in 2020. The interesting thing is that if you received a check today and then 2020, for whatever reason, phases you out, we don't know yet what they're going to do about that. We don't know if they're going to make you include the check as taxable income. We don't know if they're going to make you pay it back, or if we don't know if you're just going to straight out come out ahead for it. So, keep it in mind, keep these limitations and stuff in mind, but recognize that it is going to be based ultimately on your 2020 return. Distributions are going to be made now between now and December 31st, and if you included direct deposit information on your tax return, it's going to be directly deposited into those bank accounts.
So some tax law changes, right? So we have our due date changes. As well, they said, okay, we're going to give you some good tax law, just a little bit. One is due dates. So what they said is that now, which is what's really been on every news channel, right? You don't have to file your tax return until July 15th. So, and same with your payment. So I do want to caveat that this doesn't count if you were required to have money put in by January 15th, then your underpayment penalty would still be there, right? The question, and we don't have the right answer for you, unfortunately. Our assumption is the interest would still carry to July 15th versus April 15th on that underpayment penalty. But again, that's pretty much a fixed deal. But these are just for monies that you would have owed at April 15th. So the way to think about this is everything has been pushed. Any April 15th deadline has been pushed to July 15th. And that's IRAs, HSA, if you're required to fund any type of retirement plan by April 15th, those due dates have all been pushed to July. And so then who is this? It's a person, as an individual, a trust, an estate, a corporation, or any other type of unincorporated business entity. What was not extended, if you have a 706, that they could, but they have not ruled on a 706. That is different than a gift tax return. Gift tax returns have also been extended. And then any other items between April 15th and July 15th. So for instance, payroll tax returns, those are still due. And then there's a lot of conversation, well, what about my June 15th quarterly estimate? Well, as of right now, your second quarter estimate will be due before your first quarter estimate. So which is kind of a quandary, because then what if you want to do a really large payment in July that would cover your first and your second? Will they count that month lag period against you? The answer is they haven't answered it. We don't think so, but we have no idea because you would have filed an overpayment then on a timely filed return. So, I mean, if I were a betting person, which I bet and I often lose a lot, if I bet, that I would think they might push that second quarter too, but as of right now, they have not. Okay. So another component that they did in the Coronavirus Act is using retirement funds for coronavirus costs. Now, I would definitively check with your financial advisor about this, but this slide right here is really a summary of what's going to be on the next 3 slides in a lot more detail. So if you take money out of a qualified plan before 59.5, you pay no income tax on the distribution. Okay? I mean, you pay income tax. I'm sorry, you pay no penalty on the distribution. So if you don't repay it, you then have to pay tax on it. However, they give you a 3-year period to pay this back beginning in 2020. So you don't even have to say, oh, well, gee, I don't know. So you have a 3-year interest-free loan. And as far as we can tell, there's no interest. They're not requiring an interest on this, but we don't know. The other part about this is plan sponsors don't have to allow for this. All right. And I give you what are the 3 items you have to have. You have to have an individual diagnosed with the COVID-19 by a test approved by the CDC. So it's not like, so there's a lot of folks out there going, well, I was a presumptive positive. Well, you've got to have evidence, right? Your spouse or dependent is diagnosed with one of these 2 diseases. Well, now you have to look at it. Well, a lot of folks that have kids in college, they make them their own dependent. So in 2020, if you chose to do that for your college kid, and if your college kid is like mine, who has had a CDC test and tested positive, then you may want to make them a dependent for 2020 if you're going to do this. Because we don't know if they're going to be looking at your tax return to make the decision of whether or not you get this $100,000 out or not. Who experiences adverse financial consequences as a result of being quarantined, furloughed, or laid off for having work hours reduced. And the other one was, what if you just can't work because you don't have any more childcare, right? So they give you all of these 3 scenarios. And again, I already mentioned the 3-year payback, and you can avoid that income recognition. Some additional points down at the bottom. You can borrow from the employer-sponsored plan, right, for the 180-day period after the act passed. So remember, so you have 6 months from the date the act passed to make these decisions. So you can't, in November, well, I guess November, well, I think November is far enough out that you then can't make that choice. RMDs, required minimum distribution. So if you're 70.5, or then they changed it in the Secure Act to being 72, but all of a sudden you may have been required to take an RMD this year. They've waived that. So we've even had folks trying to figure out if they could get their RMD back. They took it before the act passed, but they really don't need their money. Needed that, but they were just required to take it, so they went ahead and took it. And could they get it back now and have it redeposited, not have to pay tax on that money, and just push it to 2021? All right, so we're going to flip through the next 3 slides quickly. Keep going.
I'm just going to pause on them so that they come
Okay.
up on the recording.
Got it. All right, so some defined, go back to the defined benefit changes. Right, so single employer defined, so if you're the employer, so if you're a single employer DB plan, defined benefit plan, then the plan funding requirements for 2020, including quarterly contributions, may be deferred until January 1st, 2021, including interest. Plan sponsors may elect to apply the plan's 2019 funded status to determine the application of benefit restrictions in plan years containing the 2020 calendar year. So again, they're trying to figure out how to make it easier for us in 2020 and going forward.
Yeah. So some changes to the charitable contributions. With the Tax Cuts and Jobs Act, a lot of individuals no longer itemize because the standard deduction increased to a level that once you capped your property taxes at $10,000, you didn't get over the standard deduction line. So that meant that you were not receiving a benefit of any contributions that you made. What the CARES Act has done is said that if you're an individual that doesn't itemize, you will now get to take up to $300 of cash contributions as a deduction in computing your adjusted gross income. This has to be cash contributions. It can't be a donation, a bag of clothes to Goodwill, but cash contributions of up to $300 will be able to be deducted on your return, even if you don't itemize. And this is in place for 2020 and beyond. If you do itemize, there had been a limit on the contributions that you could take, which was 60% of your adjusted gross income. For 2020, they've made that limit 100%. So if you happen to be in a situation where you can be extremely charitable this year, you can be even more charitable in 2020. Any excess above that will be carried forward to the next 5 years. Additionally, corporate donors, their limit has increased from 10% of adjusted taxable income to 25%. Another interesting allowance that they've made for 2020 only. Previously, employers could contribute $5,250 to an employee's qualified educational expenses tax-free. So your employer could pay, let's say, some money for your tuition to a qualified educational institution, and you would not pay tax on that, and it's expense for the employer. Now they've expanded that for 2020 to also say the employer can pay $5,250 towards the employee's student loan obligation on a tax-free basis. Now, these two categories, qualified educational expenses and student loan, are both together capped at $5,250. So you don't get to do $5,250 to each category, but the ability to contribute to an employee's student loan obligation is new for 2020 only. To the extent the employer pays for the employee's student loan, the employee cannot deduct the interest on their individual return as you would normally would.
So another quick fix. So for those of you who may have attended one of our previous seminars on the Tax Cuts and Jobs Act, one of the things that it did was they just left some things out. And so we said they needed to do some technical corrections. Well, they went ahead with the CARES Act, and they provided the technical correction on qualified improvement property fix to where they now said you could take this by giving it the 100% bonus depreciation. But what's nice about this, if you look at that third bullet point, is if you chose that you didn't have any of this, and therefore, or you did have it, sorry, and then you didn't take the 100% and now you can, they've said, well, look, you can go back and we're going to make this retroactive back to Jan 1, which means all of a sudden you could amend your tax return. However, like, you might want to wait because there's some other rules that go in here too. So don't rush just to amend for that reason. But there's some good things that are coming out you may want to amend and do some carrybacks. So now you also have some changes to the net operating loss rules. So before the CARES Act took place, there was no such thing anymore of the NOL carryback. And it's really interesting. While I always said that, permanency, when the IRS talks about what's permanent, or when the government talks about permanence, it's really just until the next act. And then here's where we see this, right? So they said, okay, there's no more NOL carrybacks. We're going to let you carry it forward indefinitely. And then you can offset 80% of your taxable income. And that was kind of just sealed and that was the fate of what we were all going to have to live with. What they've now said is we can take losses from 18. So when you go back and amend 18 and you have losses that you just created because you can take that depreciation, you can take losses from 18, 19, and 20, and you can now carry those back for up to 5 years. So now we're going all the way back to 2013. And then any losses carried to 2019 and 20 will be now permitted to offset 100% of the taxable income. So you're not limited to 80, 90, you get 100% of that money to offset your income. The other side is, if you think about it, when you were able to carry it forward indefinitely, you're now taking it, if you're in a corporate taxpayer, you're now going from taking 21% money back to 35% money. So you're going to get a nice, when you're looking back at 2013.
Yeah, it's kind of interesting how John and I did these updates just a few months ago explaining so many of the rules, and now we're explaining how they are no longer the rules. And these next two are two that fall into that category as well. With the CARES Act, they've removed the excess business loss limitation. So let's talk about what this was. With the Tax Cuts and Jobs Act, if you had net business losses, those could only be used to offset other sources of income up to $250,000 if single or $500,000 if married filing joint. Any excess loss had to be carried forward under the old NOL rules, subject to limitations of the 80%. So an example would be if you had a company that had losses of $600,000 and a W-2 wage of $600,000. 600 minus $600 losses before the Tax Cuts and Jobs Act would have netted to zero, and you wouldn't have paid any tax. Last year, and in 2018, your $600,000 business loss was capped at $500,000. So now all of a sudden your equation is $600,000 of wages less $500,000 of losses. You're still paying tax on $100,000 while carrying forward an NOL of $100,000. Well, the CARES Act has removed that. They said that you don't have to worry about excess business losses in 2020. And in fact, if you were subject to it in 18 or 19, you can go back and amend those returns to not be subject to these losses. This provision is going to kick back in for 2021 and beyond, I guess, until the next act changes it again. But certainly if you were subject to this, and we'll be reaching out to clients that were subject to this to get those amended returns in, it could be a material change to your previously filed returns. Finally, a change to the interest limitation rule. This was another one we were explaining all through the Tax Cuts and Jobs Act. Businesses with interest expense deduction, it was limited to being deductible only to the extent of 30% of your adjusted taxable income. Any excess would be carried forward. We didn't know initially how many clients, and a lot of clients didn't think this would apply to them because it applies to businesses with average gross receipts of more than 25 million over a 3-year period. So many people counted themselves out and said that they didn't have that and this wouldn't qualify. But actually, you also qualify if you're a tax shelter. And I know that sounds like a business in the Cayman Islands, but it's not. The way the law defines tax shelter is if you're a partnership or other entity other than a corporation, if more than 35% of your losses are allocated to limited partners or limited entrepreneurs. So we have a lot of partnerships who have losses that flow to more than 35% limited partners, which would make them subject to this, and they have been subject to this. What the CARES Act does is that it increased the limit for 2019 and 2020 to 50% instead of 30%. Also, in anticipation of income being lower in 2020 for businesses, and because this is limited based on your income, they said for 2020, you're going to be able to use your 2019 adjusted taxable income in that calculation. Finally, because most partnership returns have already been filed, they were due March 15th before any of this stuff really started happening. Partnerships do not get the 50% limitation in 2019. So don't feel like you need to go back and amend a return you just filed. But in 2020, however much you have saved up and suspended as suspended interest, 50% of that is going to free up in 2020. And the other 50% will remain suspended until you can recognize it in future years. So to recap, they increased the limit if you haven't filed or you're not a partnership to 50% this year. If you have filed, you can amend for this, but partnerships won't get the 50% until next year.
Well, here is our small disclaimer again. We just really want to make sure that you're not taking this out and nobody takes this out of context. This is all moving really fast. And in fact, I even got an email from someone while we've been giving this presentation, and they said, hey, my understanding is if I don't have my application submitted by midnight, I'm not getting any money. And what I know from another banker that we work with, that they're only opening their portal at midnight, and realize that the bankers have to go submit it to the SBA. So we don't know how this is really going to work on the PPP loans, which is why it's really the heavy lifting is going to be done by your banker. And then, Whitley Penn clients that are on here, please reach out and email your WP professional if you need assistance with this. If you're a guest, we have created a separate email address that will be monitored. There's a lot of information that's coming out. And then lastly, everyone should go to our website. Is what we do have is, if you are a client, what you've seen is we're trying to do it really fast, and there's quite a team. I'll do a shout out, even though I know he's not on this Zoom conference. So Scott Mayfield has technically been really trying to push information, and he's really kind of the brains with a lot of other input, but to get these alerts out to everybody. So if you sign up, you'll get those tax alerts, and realize, unfortunately, part of what we all went over, there's really, if you look at the end, that's the tax. And there's so much of this that isn't tax that we've all been trying to get our arms around. And I think in closing, Toby, who was on at the beginning, Kristen, and myself, thank you for the hour of time that you've spent with us. And know that while I know even from some clients of mine and from my firm, everybody was reaching out of me saying, hey, our prayers and thoughts are with you. Know that I can speak for everybody at Willie Penn that is I know everybody's going through a different time and a difficult time right now. That our prayers and our thoughts are with all of you guys as well as we get used to this new norm for the next month.
All right, with that, guys, we're going to end the presentation. And like it says, if you have any questions, reach out to your Whitley Penn professional, or if you're a guest today, please feel free to email your questions to caresact@whitleypenn.com. Stay safe.